It's time now for the Wall Street Beat. Bonuses are set to rise across most of the sectors of the finance industry as the market rebounds. Bloomberg finance reporter Katherine Doherty has all the details. And I've got to say, something that I find fun in the data that you collected here was that it's the debt bankers. It's not the typical stars that are actually going to be getting the biggest increases here.
That's right. Debt underwriting outperforming equity.
I thought that was cool too.
Yes.
You know, that's really telling because we're not seeing the IPOs. Yes, we've had a hot one like Figma, or a couple of them. There was the internet thing, Circle, right? But for the most part, you're not seeing that, and people are going out to get the bond market.
You're not seeing it yet. It will start to come through. So this expectation that we're reading through, this report that comes out, Johnson Associates, they're updating. And 3 months ago, when they were updating based on the first quarter, we saw actually most bonus pools expected to be down across the financial industry. That has reversed for almost everyone across the board. There's still some parts of finance that are going to be either flat to slightly down. You mentioned equity underwriting. That is one of those sectors that hasn't seen the same rebound that we have seen come through with debt underwriting.
Year is young.
The year is young, and we will also start to see some of the green shoots that all of the investment bankers were talking about at the beginning or expecting to come through of the year. We're actually starting to see a pickup in IPOs, but that might take months to come and actually bleed into 2026. So all of this activity that is now starting to peek through, it's actually a big question mark of whether or not that's going to translate into bonuses for 2025 specifically.
It's been an incredibly volatile year, right? The S&P was down to 5,000. It was up to 6,400. The 10-year was down to 399. It's been up at 480. That kind of volatility makes me think traders are just cashing in here.
It is a good thing for the traders on Wall Street. Equity trading has seen records in the second quarter. That is translating through to compensation. Debt is not quite as strong, but it's also not weak. We're seeing double-digit increase that are projected for bonuses towards the end of the year. And if that even continues further, you might see, I mean, right now, equity traders are projected to get as much as a 30% bump. That's the highest across any of the financial industry that we have seen. The question becomes, does that volatility, does the momentum that we've seen through the first half of the year continue through the second half?
Now, all of these are reasons that you see, for example, I want to pull up here Goldman stock versus Apollo's this year. I think this is stunning. You're seeing Goldman up, getting closer and closer to 30%. Wow. You see Apollo down almost 15%. I mean, I guess gained some back today, more than 10% still lower on the year. The fact that these debt underwriters are able to take back share from the banks and private credit is actually worried about this, speak through that dynamic a little bit, because there's this push-pull. 1 minute, people are worried that private credit is going to eat the banking industry's lunch, and now it seems to be reversing a little bit.
Yes, and we also have seen the partnerships between the banks and the private credit industry. So this is not as much of a or and, it's an or and because of that. And you see this constant shift that every day we're waking up and hearing about either new deals that are coming through or some more of these partnerships that I expect will continue. And also, this is a new administration, it's lighter regulation, so the big banks are going to start to accept more of the deals that were potentially getting pushed to the private industry before this.
Lighter regulation, but more public criticism?
These bankers always get criticized publicly, right?
By Trump?
I mean, 1 minute they're pulled up on Capitol Hill when the whole dumb money, meme stock thing happened, and all of the Democrats are angry because they're doing business with oil producers and gun makers, right? And now President Trump is threatening to punish financial institutions who don't do business with probably oil producers and gun makers and his followers, right? He complained that he was refused by JP Morgan and Bank America. What's the fallout going to be?
That's right. And the interesting fallout is not just on the banks, but the regulatory body too. Trump and the industry is pointing to the fierce regulation that they have been under that has led to their decision to potentially close down a customer's account because of reputational risk. That is starting to be adjusted, and it will then the question becomes, is it a big enough adjustment that you don't see as many of these bank account closures? Trump today had called out his own experience, which is a very interesting thing. You're not just hearing about the regulators, you're hearing about the president's personal experience that he is speaking to with some of the biggest U.S. banks. So now we're expected to see some of the fallout that you're asking about is going to be on the banks reviewing their own processes, and then also on the regulators reviewing how they're regulating the banks for potentially pushing them to make some of these decisions that they otherwise might not.